Hello and welcome to Currency Point, presented by me, Evan Lucas, for FP Markets. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature, none of it should be relied upon as any form of advice. FP Markets does not know your personal scenario, nor your personal financial goals, and therefore none of it should be relied upon as any form of advice at all. It's just general in nature only. Big change in the US dollar, and I need to put my hand up and say that very clearly because I know I've been really strong on buying into it, and I have been that kind of strong probably since around about May this year. But we did see a big handbrake last week, and what I want to talk about now is it's possibly, in my eyes, the fundamentals that have driven that in terms of the change that's coming from the board. And I now think that the September FOMC meeting is going to be the big event for this month. That was obviously very obvious. I'm not stating anything here that's completely out of character. It's more what we have got over the last week and what we're likely to get over the next week leading into the weeks and a half times FOMC meeting is that although data is really positive, it's not positive enough. And if we look at the non-farm payrolls, ADP, look at the jobless claims, they're all really strong and they're all really positive. There's no doubt about that, but they're slowing, and that shows that the discussion around transitory is probably right and it is starting to move back. We are still seeing, non-farm payrolls averaging around about 800,000 over the last few months. If you look at ADP, although it slowed back last month, still doing incredibly well. Jobless claims are nearing the highs that we've basically seen in the post-COVID world, and they're not far away from getting to the pre-COVID world either. You're also looking at the number of claims that have been made year on year are falling to levels that we basically haven't seen since COVID started. They're really positive, and that needs to be put there, but they're not enough to really push that number one mandate of full employment. And that's an interesting thing to say because wages are actually all right, but wages are growing at the bottom end, not at the top end of the market. So maybe there's still capacity to go there. You then also look at forward projections for growth and things that are outside of the US's control, and realistically it's outside of the world's control. We here in Australia have the same problem, which is that supply chains are being interrupted. Semiconductors is obviously a massive part of US manufacturing. Their tech and auto industry heavily rely on it. And you've got constraints already, but now you've also got port closures issues in Asia that are making it even worse. So maybe the hard and short period that was expected with semiconductors is now going to be hard and long. And that's being factored into GDP. You can also see that it's starting to actually impact domestically on general services, on general goods, your ability to get things like lumber, your ability to get things like copper and copper products for the home is slowing down. You can see that in terms of what's going on in new builds and new construction work. Because they're having supply chain issues, it's just taking the shine off GDP, which is still incredibly strong, forecasted to be about 3.7% in the third quarter, but it was 5.3%. So there is a drop here, and that therefore means that inflation is also going the way of lower numbers. PCE is now forecasted, according to the Atlantic Fed, from going from 2.6 down to 1.9. So we are below the Fed's second mandate of 2%. Transitory effect is there. I will probably caveat, getting back to the point around sort of things like semiconductors, it will impact exports, it will impact also what's going on in their local automotive industry, but it also means that inflation in that space could stay up. So it could be a bit of a caveat to the PCE, but PCE strips that kind of thing out. Just another caveat to watch at. Overall though, all of that means, and what we're starting to hear from the board, is that we're just not there to really move on what we thought we should. They're talking about tapering, that's clear from what we saw from Jackson Hole, but maybe they're just not in a rush. And it was succinctly put by Raf Bostic, who basically said, at the moment, we want things to overrun. And that was his term, we want things to overrun. So maybe, yes, we could see tapering in November or December, but the more we're listening to them, the more they're suggesting that they'd actually rather it go faster and harder than slowing it down sooner rather than later. The only thing that can probably interrupt all of this is that September is the first time we get 2024 rate movements from the board. It will give us a bigger understanding of the longer run average of where rates will be. But I think they're telling you very clearly that next year it's unlikely that we're going to see US interest rates rise. Tapering will probably have started, but maybe not at the pace that some expect. And it could actually still be going this time next year because we still just don't know the full effects of what's going on with Delta and how Corona could probably evolve even further next year as well. So all of that comes back to my point. The US dollar has seriously fallen away because of all this information. All that drive towards the idea that tapering was going to start soon has possibly dissipated. You can have a look at euro dollar, have a look at cable. They're back above and at 1 month numbers, but they're back above sort of really interesting levels, 137 into 138 for cable, 117 to 118 now for euro dollar, but it's the Aussie dollar that I can't go away from. I'm still very negative on it, and I think you should be, but I've got it wrong, and I put my hand up and say that from the point of view that it was testing 70 cents just over 10 and a half days ago, and we're now sitting at 74. We were at 71.19 and it looked like going further. And it's not the Aussie dollar side. Last week's GDP figures were robust, but we know right now we're in recession. Victoria and New South Wales locked down for at least another 6 weeks. It's not going to help third quarter. Also, iron ore, although it's bumped a little bit, it's certainly not back to where it was. It's still 50 bucks or so US a ton away from where it was in May. So it's not the Aussie dollar side, it's the US dollar side. And that, I think, was just relieving a bit of pressure that was built in that pair. But I'm still of the view, over the medium term, towards the back end of the year, that pair will go down. But I had got that wrong, and I need to put my hand up and say it.